Thank you, Jeanette, and welcome everyone. Thanks for joining our webinar today. My name is Bruce McFarlane. I'm the Managing Director of Blue Rock Law, and I'll be your host for today. For those of you who haven't been working with Blue Rock in the past, we're a multidisciplinary professional services firm. So as an entrepreneurial advisory firm, we have both businesses in law, accounting, digital, wealth, finance. We've got a property consulting business and a number of other businesses. About 100 people in those businesses. We've also got an investment part of our business, so where we part own and assist in operating a number of businesses. That's given us really good insight into what's going on at the moment in the economy with the COVID-19 crisis. So obviously we've got a number of clients we're advising and also businesses we're operating ourselves. So today we've got a fantastic panel for you to discuss both the financial impacts and the legal risks of running a business during the coronavirus crisis. So today, just before I get started on the discussion today, a little bit of housekeeping. So for those of you who haven't joined the webinars that we've been running before, we have a Q&A function at the bottom of the screen so you can see. So if you'd like to ask any questions, please use the Q&A function. All of the panelists will get those questions and we'll try and answer those questions on the way through. If not, we'll send an email out today for all the attendees, which will include some information about the questions that were asked today, as well as some of the topics that we discussed. We won't be using the chat function today. Later on, we'll have some opportunities to actually ask some questions live. So there's the raise your hand function at the bottom of the screen there. That we can use, so we can ask a question. So if you'd like to save it up and ask it rather than type it, that's fine too. We can go with that. So I'm going to get started in a minute, but I'm going to introduce our panelists. So Paul Evans is one of the directors in our accounting firm. So welcome, Paul.
Hi, how are you, everyone?
So tell us, Paul, what's your practice in the accounting firm?
So yeah, my clients, I guess, are everything from small to medium-sized business owners. We help them with everything from lodging BASs to acquiring businesses, structuring, tax, strategic planning, and just about anything that a business owner, I guess, comes involved with.
Cool, thanks, Paul. And so Tech, welcome. Tech's a director, heads our litigation practice in the legal firm. So Tech, tell us a little bit about your background.
Hi, Paul. Hi, everyone. Yes, I've been in practicing law for about 20 years, predominantly in commercial litigation, insolvency and bankruptcy. I am only new to Blue Rock, but in these times it's been good to be part of a good organisation that offers great legal services and is part of a multidisciplinary firm offering outside of the legal services. So that's thank you for bringing me on board, Bruce.
No worries, Tech. And so our third panelist today, so outside of the Blue Rock family, in the broader Blue Rock community, we've got Scott Anderson from Worrells. So Worrells is an insolvency firm. So Scott, tell us about your practice.
Hi Bruce, thanks for having me join you guys today. So my practice is all forms of corporate and personal insolvency. So I've been sort of at the coalface of financial distress for 15 years, focusing on small, medium, large enterprises, and also have a bit of experience dealing with financial fraud and hedge funds as well. So it's pretty well placed to assist with all facets of people in business.
And in terms of industry, Scott, I think you've got quite a bit of experience in retail and hospitality. Are they two of the areas that you've worked in quite a bit?
Yeah, absolutely. Spent a lot of time in retail, hospitality, and probably more so in the hospitality space as well in recent years, yes.
And you missed out on the Virgin job, so you're a bit upset, I'm sure, about that one, but there's other...
Look, there's always an opportunity there because creditors can look to replace the administrators at the first meeting. So, look, we might have a consent to act being tabled at some stage, but that'll remain to be seen.
No worries, watch this space. So, Paul, we're going to start with you. So, obviously, managing cash flow and your financial position is really critical at the moment. So what should business owners be doing to have a look at their current financial position during this COVID-19 period?
Yeah, sure, thanks. Look, I guess ultimately what business owners need is a clear understanding of their cash flow position over this time, so the cash inflows and outflows, in order to make sure that we have enough cash to survive this downturn that we're going through at the moment. So what we're doing with our clients is how we achieve that, I guess, is by building out a full three-way forecast of the business. So what do I mean by that? A three-way forecast is we're looking at a review of the P&L and trying to forecast out what the P&L looks like through that forecast period. Looking at the balance sheet as well and understanding what cash movements occur on the balance sheet that don't necessarily are reflected in the P&L. And then combining those activities into a full cash flow forecast. So just, I guess, a quick higher level sort of look at how we do that on each step. So looking through the P&L, you're looking at obviously the operational items that are going through there. So the big one being revenue. So let's try and work out and forecast what does our revenue look like over the next 3 to 6 months. What sort of downturn are we expecting? How have we been impacted, I guess, by what's going on? Looking at, is there opportunities for alternate revenue streams as well? So, is there other ways for us to generate revenue with the workforce that we have if we're not able to do it by conventional manners? And then looking through our, obviously our big ticket items such as rent. Obviously there's a lot of information out there at the moment about the code of conduct that landlords and tenants should be working with each other on to negotiate a reduction in rent. Going through our suppliers, again, having open discussions with our suppliers about discounts and extended terms, stock levels, should we be reducing stock at the moment rather than buying stock? A review of things like direct debits that we sometimes forget about that are going through our bank account every month. It's a good opportunity to stop and have a look at some of those and make sure they're still relevant and still required in the business. Insurance premiums. So not saying to go out and cancel our insurance, but by all means, it's a good opportunity to sort of sit back and have a look and make sure that the insurance coverage we have is relevant and at the right level for where our business is operating at. And then going through those discretionary items, such as entertainment, staff amenities, travel, all those types of things to make sure, we're, I guess, tightening the belt as much as we can at the moment. Obviously, the other big expense is labour costs. So are we managing our margins, I guess, on the revenue that we are able to bring into the business by flexing our staff, our labour costs in line with that? Whether that's management getting more involved with the active day-to-days of the business, at those lower levels, operational staff, are we maybe job sharing, or is there an across-the-board wage cut required? Obviously, all within the bounds of the legal aspects that we need to adhere to. So that's I guess, just a very quick sort of overview of what we'd be looking at on the P&L. From a balance sheet perspective, obviously debt's a big one, so we need to be looking at our debt levels. What sort of repayments do we have on debt at the moment? The bank's obviously been quite accommodating with either converting some of that debt to interest only, or even giving repayment holidays altogether. Or can we refinance over a longer period just to bring those repayments down? Looking around your business to see whether there's equipment that's idle and maybe been idle for a while. Is now a time to actually liquidate some of those assets and try and convert them back into cash to help the business. Looking at drawings and dividends, those profit distributions that business owners are taking, are they still relevant and aligned to the performance of the business? Maybe it's time to make some adjustments there. And as I mentioned earlier, sort of looking at your debtors, starting an open dialogue with your debtors to understand the health of your client base, to see what sort of recoverability do we expect to get from our aged debtors and maybe even our current debtors as well. And same with your creditors, sort of, conversations with them again to see how we can push all that out. So that's sort of like the P&L and the balance sheet review, I guess, and then bringing all that into a forecast process. We're certainly not just, we're looking at multiple scenarios here because we honestly don't know, I guess, what the impacts of the coronavirus are and how much it could drop our revenue. So we're looking at least 2 or 3 different types of multiple scenarios on revenue drops and how we can maintain our margins through those different revenue drops. And then bringing in those, the drawings, the debtor day increases, how's that going to impact cash inflows? pushing out your creditor days, how is that going to help with the cash outflow reductions? The debt repayment scenarios, factoring all that stuff in. And then obviously the big one that everyone's become familiar with at the moment is the ATO stimulus payments that we'll get into. But you know, how and when and how big are those payments going to be, and when they're going to come in, and how is that going to affect you over the next 6 months as well? So it's really just having that clear sort of 6-month projection process, I guess.
Yeah, and obviously cash is the key at the moment. So making sure that, you know, with those different scenarios, what's the actual cash position in the short term is key. So,
well, it's absolutely about trying to retain as much as you can to help you survive through this period, so we can, you know, hopefully get through it and get on the road to recovery.
Yeah, and some of your clients, I know you're talking to them about now. If the situation was a 20% drop, what would that look like? If it's a 40 or a 60% drop, is the business sustainable in the, you know, in the sort of medium term? So,
yeah.
Yeah,
well, and that's it. And it's certainly not a document that you sort of do and don't revisit. As this progresses, so does the impacts and our understanding of those impacts on the business.
Yeah. And so you mentioned the tax office. Obviously, the government comes to the table with a lot of stimulus packages and incentives for businesses to help them through this period. And we're going to be considering later in the discussion around what happens if those things, when they finish, because it's going to be tough.
Yeah.
The banks and the tax office, not normally your best friends in business, at the moment are everyone's best friend. What sort of things are in place at the moment?
There's lots of things in place at the moment. Look, and we're still working through the implementation of some of these incentives, and the ATO is still working through how to practically sort of implement that, I guess, as well. But we'll run through, I guess, high level what some of those are at the moment. It could obviously be a webinar of its own, but the lawyers will get upset if I take up too much of their time. So we'll just.
We said we're going to turn your video off.
Oh, that's right. You were going to turn the video. All right. Look, very high level. We'll run through. So the cash flow boost program, predominantly made up of the PAYG withholding credit refunds. So that's a $50,000 up to a $50,000 refund of your PAYG credits pre 30 June, and then another $50K post 30 June. Dog says hello. That's a minimum of $10,000 pre 30 June, and then you'll get that $10,000 again post 30 June. So that's non-assessable income. Largely revolves around what we lodge in our March BAS. So if we're monthly lodges there, we're going to get 3 times that back paid to us in April, and they're just starting to come in now. Again, up to that 50K cap. And you get the opportunity to top that up in your April and May IS as well. If you're a quarterly payer, then it'll be based on your March BAS, and you'll get another opportunity on your June BAS. And then essentially whatever you got in that first 50K opportunity, you'll get again in the second 50K opportunity post 30 June. There's also the PAYG instalment refund. So if you've prepaid any tax throughout the year for the 2020 financial year, you get the opportunity not only to vary your March and June BAS instalments to nil, you can also ask for a refund of what you may have already prepaid in September and December. And I guess the upside to that this year is that there's no penalties or interest if we happen to need to pay tax when we lodge our 2020 tax return. The JobKeeper, lots of conversations going on about that at the moment. I'll try and run through that nice and quick, but essentially it's a subsidy that's going to be paid to employers, I should say, a flat $1,500 per eligible employee. Lots of criteria to run through, but we're slowly getting our head through the detail. Largely, so for businesses to be an eligible business, and we're talking, if you've got turnover under $1 billion, it's a 30% reduction in revenue. The wording around, I guess, the direct comparison method is to look at a relevant month, be it like a month or a quarter period, typically the June quarter. If we've experienced or expect to experience a drop of 30% in revenue compared to a period last year, the same period last year, then we're an eligible business. if we don't fall into one of those categories, and that may be because we're a startup or we've acquired a business throughout the year, and therefore we've grown through acquisition. And there is alternate tests. The ATO haven't actually given legislation on this as yet, so they've given us some guidance, but we're still waiting for a little bit more information on exact alternative tests. Employees, to be an eligible employee, you need to be employed by the 1st of March and either full-time, part-time, or as a long-term casual, so that more than 12 months. You need to be 16 years old, an Australian citizen, or I think there's some visas that are eligible as well, particularly for New Zealand citizens. You need not to be receiving the apprentice incentive. You can't get both for these employees. And you can also nominate one business participant per business as well. So be a director, a shareholder, or a beneficiary that's maybe not paid a wage at the moment. The payments are $1,500 per eligible employee. That's a pre-tax payment, so this is taxable wage. Superannuation is required on any amounts that the employee is actually turning up and performing duties. So if they're only paid $750 to actually come and work for a day or 2 days, whatever the case may be, then the top up, it's optional as to whether you pay superannuation on that top up to the $1,500. The first fortnight is 31st of March to the 12th of April. So that's just starting to get worked out now. But we need to have paid that to the employee, physically paid it to the employee before the end of April. As I mentioned, there is apprentice incentives as well. So for businesses that have less than 20 employees, there's a 50% wage subsidy for that 9-month period from the 1st of Jan to the 30th of September, and that's up to 21K per employee. How much time have I got left, Bruce? 150K. 150K instant asset write-off. So if we do have any money, the ATO, the government are giving us some very favourable tax deductions on instant asset write-offs. But if you've got turnover of less than 500 mil and you've bought an asset between the 12th of March and 30th of June, you're going to get a 150K deduction if it's worth less than 150K. If it's not, if it's more than 150K or you bought it after 30 June, you're going to get a 50% deduction for that, the full value of that asset. Plus, you can depreciate whatever's left at the applicable depreciation rate.
Yeah, it's actually the business for retail and hospitality businesses that need to do a refurb or a fit out, and particularly they've closed and do have access to some cash. It's actually not a bad time to use up that asset write-off.
Yeah, look, I mean, obviously the clincher there is if they have the cash to do it. Yeah, absolutely. It's never been more favourable. In terms of these instant asset write-off deductions. The ATO have come to the party, as you said earlier, Bruce. They're always our best friends, unless there's one watching. But they are being very helpful in terms of favourable payment plans, lower than normal interest rates. There is a 4-month deferral you can get for income tax and FBT payments. And if they have charged you any interest or penalties since 23rd of Jan, then we can get a remittance of those penalties. The state government, so the SRO, it varies from state to state, so I won't go through that, but there is some payroll tax exemptions there and land tax exemptions in line with rental waivers. And then again, on a state-by-state basis, they've offered some $10,000 grants for small business as well. Won't go through the detail of those. We're happy to take questions if they come up. And then just broadly, I guess the 250K SME guaranteed business loans as well, which quite a few of my clients are taking up the opportunity just to have that little comfort, I guess. Should things get that dire that they've got that 250K or up to 250K to call on. And that's a loan guaranteed 50% by the banks, 50% by the government. So it's a 3-year loan, but nothing's required for the first 6 months in terms of repayments. There's no fees on the loan, and you only get charged interest on the amounts that you've actually drawn down on rather than the full amount of the loan. So lots of incentives.
Yeah, I touched on a couple of the ones that you mentioned there. So obviously JobKeeper, we've run a couple of webinars that are on JobKeeper alone. There's a lot of detail in the JobKeeper scheme that Paul and his fellow accounting directors have run through for clients. So if you want any additional information about JobKeeper, I saw there was one question just around nominated director, but on our website, we've got a whole area dedicated to the JobKeeper stuff. So there's information there. The leasing side of things and negotiating reduced rent was one of the things you also mentioned, Paul. So again, we ran a webinar yesterday just on that topic. So if you'd like to see that webinar or you'd like any information around the National Leasing Code, we've got information for that as well. And I guess finally, those loans. So our finance division, Steve and Jamie, the directors of our finance division are working really closely with the banks around those government guaranteed loans. And so there's information that we've got for people to assist. The banks, it's tricky. It's very difficult for the banks to process all of these things at the moment. So what people are finding is that it's taking a while to get access to that. That's if they can get it. And I'll sort of lead through into tech that with the bank, with people having levels of debt already, lots of directors have signed personal guarantees on trading accounts, on leases, on equipment. They're talking to their banks and they're getting time off. But how can they protect themselves as directors from, some of these guarantees being enforced?
Yeah, good question, Bruce. Well, the first thing that directors need to know is not to panic. There's several things that you can do to limit your exposure, or at the very least to calm yourself down, considering that personal exposure under guarantees is a serious matter. Firstly, what I think you need to do is take some practical steps, and that's contact your credit and have a discussion about your financial situation. Put them on notice that you're deactivating your account or you're looking to deactivate your account and that you're withdrawing your guarantee. This needs to be done in writing, and although it doesn't void the actual guarantee, it does limit your exposure moving forward. So that's one practical step you can take. Secondly, get some legal advice in relation to your guarantee document. It's a technical area, and in my 20 years of experience, I've seen some poorly drafted guarantees and indemnities, and I've been able to leverage the shortcomings to void the guarantee or indemnity document. It's not a huge cost, and lawyers are well versed in doing this kind of work. So go see them, and in some circumstances, it might save you thousands of dollars. In fact, I've got a couple of matters that are sitting on my matter list that relate to this particular topic. In terms of the laws and guarantees, well, here are some of the comments I've got. The direct guarantee documents continue to for the life of the underlying account. A director can be liable for debts regardless of whether it's caused by themselves or people running other people running the company or acting on behalf of the company themselves. And your obligation in relation to the guarantee may even apply after you've resigned as a director of the company. The company stopped trading or the company is deregistered or wound up. So the easiest way to get out of director's guarantees is ask the release from the creditor directly, and that again needs to be in writing. In cases where there are multiple directors, which I'm assuming that a lot of our listeners and viewers might have multiple directors in their companies, on the one account, you're entitled to apportion the liability between the directors or those that have signed the guarantees. This is generally done by joining them to proceedings or actions taken by the creditor against them in respect to that particular account. So just remember that if, for instance, you're one of 3 or 4 directors in a particular company and there's a call on your guarantee, although you can't ask the creditor to go after the other directors, you can join the proceedings and apportion the liability through that process. Now, there are some sort of technical steps that you can take to have the guarantee set aside. This is generally difficult to do because a lot of guarantees these days are drafted well. When I made that point about being able to leverage of poor guarantees, that's from old guarantees, but there's some good precedents going around. But there are some circumstances which you can get them void. So when you are sitting down or you are getting pressured through enforcement guarantee claim, have a look at a few things. Have a look at the circumstances which the guarantee was into. So things that can get it set aside is elements of misrepresentation or misleading and deceptive conduct, mistake, duress, or unconscionable conduct. Obviously, if you can show any of those elements, then the guarantee can be set aside for being void and then enforceable. Generally, there is another step that you can take if, for instance, you are being pressured by a creditor to, by way of enforcing a guarantee. You can place the company into voluntary administration. That is a mechanism that will stop personal directors' guarantees from being enforced. And if the creditor wants to do that, they'll need to get court's consent to be able to enforce those. So just like unsecured creditors, landlords and secured creditors, and when a company is in a state of a VA, in those circumstances, a guarantee cannot be pursued, and that can buy our clients some time in respect of those proceedings, and be able to work out a better strategy moving forward.
Okay, so I guess you get to a situation where you've tried to protect yourself from any guarantees, but things go a little bit further, and there's potentially a claim for insolvent trading, and on a guarantee enforcement claim or some other thing. So what defences are available to the directors to protect themselves at that point?
Yeah, look, when you're facing an insolvent trading claim, it's often the dire circumstances, and you do need to get some professional advice. So step one would be get someone on board who's done this before. Talk to your accountant, talk to your financial advisor, talk to your lawyer about what you need to do. So that's first step one. Step two is understand what insolvent trading is, for instance. And let's just focus on insolvent trading for the time being. In my experience, directors struggle with this concept sometimes. They don't see a line of where insolvent trading start, when they start trading insolvent, when they don't. So just understanding about and jumping on the internet, looking through some information about insolvent trading would be step two. So get yourself familiar with the concept. And the other thing that I found is that most directors believe they can trade out of poor financial positions, even after getting a solvency report done. My experience is that's fairly difficult unless you take some drastic steps. So so let's come back to the core information around insolvent trading. It is an offence for a director to trade whilst insolvent, and it's an offence under 588G of the Corporations Act. And it's quite simply defined, and insolvency in the Corporations Act is quite simply defined. It's an ability to pay all your debts as and when they become due and payable. So fairly simple. If you can't do that, you're likely to trade. You're likely insolvent, and therefore you can't trade on. But for instance, if you are thinking that you do believe that you are trading insolvent, or there is a suspicion of insolvency in respect to your business, get it tested. And there's two ways you can test your solvency. And the first way is through a cash flow assessment. You can do that with your accountant. You can do that with our accountants at Blue Rock, or you can sit down with a lawyer and try and figure out whether you're cash flow positive. And this involves an assessment of the ratio of current assets versus current liabilities. And then the secondary focus is on whether the company has an overall net surplus. There is a second test that our clients can use, and that's implementing what's called a balance sheet test. Now, it's largely been moved away from by the courts in respect of using this test, but it's still a good way to determine whether you're solvent or not. And that's just the determination of a balance sheet insolvency is based on a comparison of net assets of the company to the amount owing to the creditors, and the likelihood that it would not be possible to pay these debtors when they fall due. So let's move forward and crystal ball. Let's say, for instance, you've done all the tests, you realise that you've been trading insolvent. There are some protections and defences available to directors. The first thing that our clients should know, and the viewers and listeners should know, is that there is a public interest test in the Corporations Act. And unless the court believes there's an absolute public interest it will serve the public well to pursue a director for insolvent trading, then this section under the Corporation Act can be used. And generally speaking, and very rare, and maybe Scott can sort of attest to this later on, when, for instance, there's claims for less than 50 or 70 or 100,000 in insolvent trading, it's unlikely that it serves any interest to the public pursuing these type of directors. That's my experience, and it tends to be reserved for those kind of cases. But if you do but the next step is, if you are thinking that you're expecting that an insolvent trading claim to be issued against you, start compiling your evidence in relation to your defences. And the defences are, if there's no reasonable grounds to expect insolvency, then you can't have been trading insolvent. And an accountant can help you do that by checking through your P&Ls and your balance sheets. And then there's the other defence that you've reasonably relied on information provided by other professionals. So again, you look to your lawyer, your accountant, your financial advisor, and if they're telling you you're trading well and you've been doing well for the last couple of years, that's a ground that you can use in your defence. That you're absent from any management from the business. This is largely reserved for larger type of companies. And then, of course, there's the last defence, taking reasonable steps to prevent incurring any further debt. Now, all this can be documented. If you ask, is there suspicions of you trading insolvent under the circumstances, I'll start compiling evidence in relation to those defences. And just very quickly, and I'll let Scott touch on this a little bit more later on, there are things like the safe harbour provisions in the Corporations Act, entering into voluntary administration. And then once you're in voluntary administration, there are two ways that you can extend the life of the company by bringing professionals, and that's by through a docker or a holding docker. There's slightly differences amongst those concepts, and Scott and I can touch on it further on. But if there is suspicions of insolvent trading, just remember that you can do all that, including, of course, and finally, which we don't propose that you do at the very outset, is tip the company into voluntary liquidation. That's your final step. That's something that you would consider after you've gone through every option. But those are the steps that you can do. Those are the defences that you can raise in respect to insolvent trading. But most of all, make sure that you get some professionals on board to help you in that respect.
Thanks, Tech. I might go straight to Scott now to talk about some of those things we've been touching on. So I guess, Scott, in your experience, what are the signs for a business owner that things aren't going well and that they might potentially be trading whilst insolvent?
Yeah, certainly. Thanks, Bruce. Look, to start with, I think Tech's probably laid the foundation for the insolvent trading tests quite well. And it's the way that we look at it as well. It's the twin test, so to speak. You have the cash flow test. So essentially there's a cash crisis, which may be indicative of insolvency itself. And then you also couple that with the balance sheet test that Tech touched on as well. So very simply, it's where your liabilities exceed your assets. And then if you take that to the next level, you take it to, are your current liabilities in excess of your current assets? And so if that's the case, well, then you've probably got an issue with solvency. And then if you put the two together, then you've definitely got a solvency crisis that you're embarking upon. So practically speaking, the way that we look at insolvency and the indicators of it in what we do, it really comes down to a case which was instigated by ASIC back in 1997. And for the people out there that might want to have a look at it, it's ASIC versus Plyman case. And it involved a company or a group of companies called the Waterwheel Group. And for those out there as well that might like a bit of history, it involved John Elliott as one of the non-executive directors. From that case, ASIC took steps to have criminal prosecution against the directors for insolvent trading, as opposed to the civil proceeding, which would be made against the directors for compensating the company for losses incurred whilst it was insolvent that it couldn't pay. And out of that case came a bit of a shopping list of 14 points, which point towards or are used to determine when a company is going to be insolvent, so the indicators. And I'll just run through these quickly for you, Bruce, and everyone out there. So the first one is that there's going to be continuing losses from a P&L perspective. There's liquidity ratios which are below 1. So that's your easily convertible assets into cash, so your debtors or your stock and your actual cash, being less than the immediate debts payable. Other indicators, you've got your overdue Commonwealth and state taxes, so if you've got payroll tax, SROs, following up the payment because they're owed a sum. You might also have the tax office there for pay-as-you-go withholding, and also superannuation and GST as well. You might have a poor relationship with your bank, and what that usually looks like is that you're at the limit for your overdraft or your business loan, and the bank's not really not all that willing to extend further credit to you. And coupled with that, an indicator will be you've got no access to alternate finance as well. And then on the equity side is that there's no one out there that's prepared to provide further shareholder funds to fund the business. You'll have, or indicators will be suppliers potentially putting the business on cash on delivery, so that's a stock credit arrangement. They might be demanding payments before suppliers even made, so that would be a circumstance where some of the old debt's being paid off, and then some of the new purchases are being paid before they're delivered. So to pay off some of the old. Now this is probably an indicator of the times that issuing post-dated checks. To be honest, I don't see too many checks these days. I'm sure a lot of people don't either. Dishonoured payments or dishonoured checks. It's probably more dishonoured B-pays now.
Yeah.
And direct debits. Special arrangements with creditors. There's always going to be, or there could also be, solicitors' letters, so demands for payments, summonses, judgments against the company, warrants of execution against property. And then one of the more pertinent indicators where there's a problem with solvency is if there's payments of round sums which don't actually reflect an invoice amount. So you're essentially just trying to gather up whatever cash you can to be able to pay some of the old debt off. And then finally, and this usually happens when insolvency is a real issue, is that people tend to focus on the day-to-day mechanics or operations of the business and fail to really look at the financial documentation. So making sure all the financial documents are in order, they're being maintained. And that is one of the indicators that we see that people tend to neglect when there is a solvency crisis that they're encountering.
Yeah. So and a lot of those things are happening for business today. Obviously, the government and the ATO are helping people, and the banks are everyone's best friend, as I mentioned earlier. So people are working with their banks to ensure that that's not the case, that they're not at the end of their limits. So we've got to that position. The directors have had a look at that and thought, hang on, now this is not great. The outlook's not great. Maybe in the short term I'm okay, but in the longer term I'm in a bit of trouble. What should they be doing? Like, what are their options that they can do at the end of that?
Yep, certainly. It's look, the way that I see it is usually 4 or 5 options are going to be available to anyone that's falling on hard times from a business perspective. Now, the first one is an informal arrangement. And so that basically involves engaging with your creditors to get some sort of arrangement in place where they may informally accept a compromise to their debts, or they might look to instalment arrangements over a period of time. Now, practically speaking, that's probably going to be very difficult to get done. Setting aside at the moment, it's probably capable of being done because of all the assistance that the government's putting out there as well. And all the best example is the codes, the national code releases at the moment. So it might be applicable now, but practically speaking, if you've got more than, say, half a dozen creditors that are pursuing the payment or they've fallen behind, is the difficulty in that is it just takes one of those creditors to take action to bring an informal arrangement down. Because if one creditor decides to enforce their rights by issuing proceedings for judgment against the company or issuing a statutory demand for payment, well, it means that everyone else is then going to be brought along with whatever the repercussion is. So if there was a court order for liquidation or the like. So you really have to have a small number of creditors to be able to manage the informal process with them. Now, the next step that directors may want to be considering is whether or not to elect to enter what's now known as safe harbour. And so that was it's a regime which was created with the law changes in 2017. And essentially what it does is the directors make an election to enter safe harbour. Then that is a confidential election as well. There's no public register for people or companies that have embarked on that process. So the only people that know about it are the people that the director knows. And so the overarching objective for a director entering into safe harbour, or at least the company is there's a plan formulated to turn around the circumstances of the company, which will provide for a better outcome than what the case would be if a voluntary administration were to be immediately embarked upon, or a liquidation for that matter. And the director, by making that election, also receives protection from personal liability for an insolvent trading claim for the period that the safe harbour election is in force. So that steps back to dealing with some of the risks associated that all the directors are probably encountering at the moment in relation to the insolvent trading provisions. Yeah, there are some technical aspects to bear in mind in terms of qualifying or meeting the criteria to make the election. Probably the more important ones are that there can't be any outstanding employee entitlements for the last 12 months. So that's probably more looking towards superannuation being paid up to date. And then from the statutory reporting perspective, is that the company has to materially comply with its ATO reporting and lodgement obligations for the past 12 months. Look, there can be one or two instances where they haven't complied materially, but you'd probably be looking at that very closely because if they haven't complied or if the turnaround doesn't work, well, then there is a risk that you won't get that protection. One of the things that Tech touched on as well, it's probably option number 3, is voluntary administration. Now, voluntary administration, it's a formal process governed by the Corporations Act. It is designed to resolve a company's future direction very quickly. It can be instigated very quickly, merely by resolution of the directors. So you can do that overnight. Now, the voluntary administrator takes full control of the company's affairs with a view to saving all or some of the company's business. And that provides for a better outcome than what would the case be if it were to be put into liquidation, where the liquidator just steps in and then takes steps to realise the company's assets for the benefit of creditors. So they're probably, and then finally, that liquidation scenario. So they're the 4 ones, really.
So we might sort of talk about some examples there. So what about a situation where you've been involved where there's been a voluntary administration and there's been a docker, and how that's worked, or the process has worked?
Yeah, certainly. I think Tech touched on this quickly as well. Is one of the best aspects of the voluntary administration regime is that it provides a moratorium for the company against creditors enforcing their claims against the company, and it also provides a moratorium from landlords executing their powers under the lease to enter in possession of the property. So technically speaking, if I'm an administrator, the landlord cannot take possession of the commercial premises. Probably the best recent example that I've got at the moment involves a fire services or maintenance business, and they're also doing the installation of sprinklers in commercial developments. And essentially the situation is that the construction or the installation side of it had been running at an absolutely horrific loss for many, many years. And the directors had been funding the losses to the tune of $600,000 that they were owed by the company. And then on top of that as well, the company owed about $450,000 to the tax office, and the SRO was owed another $150,000. Now, they embarked upon a process of trying to shut down the construction side of it, and they did that. And then they went to market to sell the maintenance side of the business. And at the same time, trying to keep those creditors, the statutory creditors, at arm's length in an informal sense. Heads of agreement had been signed for the sale of the maintenance side of the business, and it was signed at about $450,000. Then when the purchaser was doing their due diligence, SRO and ATO became a bit frustrated with not being paid. So then SRO issued a statutory demand for payment, and the tax office issued director penalty notices for the $450,000. So what that meant is, to avoid the directors becoming personally liable for the director penalty notice, is that the directors had to appoint an administrator within the requisite timeframe, and also to overcome the incoming winding up by the court because of the stat demand, is they appointed the administrators. So we became involved. As voluntary administrators, we traded the business, and we then had to, in our process, had to advertise the business for sale. Now, whilst that was happening, we also received a deed of company arrangement proposal from the directors. Now, basically, a DOCA is a document put to the administrators who put it to creditors. It's essentially an attempt to do a deal with creditors to compromise claims or to restructure the debt. So in this situation, we look at the DOCA terms, which is provided for payments over a period of time from future profits. The DOCA payments were personally guaranteed by the directors. There was a limit security put up by the directors to secure those payments as well. And the related parties also subordinated their claims to the DOCA fund. So the short version of the outcome was that the deed of company arrangement was accepted. We handed the keys for the company back to the directors, free of all of the old debt, so the $600,000 in statutory debt to the tax office and SRO. And all they then had to do was continue trading subject to the terms of the deed of company arrangement, which just involved making $4,000 or $5,000 instalments a month over the course of 18 months. And so they're continuing to trade at the moment, subject to the terms of the DOCA. The last time I spoke to the director, I believe his intent was that he wanted to finish the deed as quickly as possible so he can pay it out early. And as soon as he was doing that, setting aside the current circumstances with coronavirus, is that he's going to put it back out to the market and actually try and get a sale at that $450,000 amount again, which was out there prior to us becoming involved. So it's...
Yeah, so Tech, have you seen the DOCA as a good strategy to help the directors sort of pause and then reset?
Yeah, I think it's one of the better mechanisms that we've got available under the Corporations Act in relation to companies that have gone under or about to face some difficult decisions. I think that Scott, you raised a good point about the option under a DOCA of handing the business back. I know that a lot of our clients are in circumstances where they're emotionally attached to their business, and under the circumstances don't see too far ahead into the future, and they don't want to release the company or lose their company in a liquidation scenario. So to our viewers and our listeners, it's important to understand that even though, and like you probably have seen in relation to a lot of the Virgin Airline snippets on the news lately, voluntary administration is not a liquidation. It's something different, and the options available to you in that a VA is to put up a DOCA or a scenario where you're paying a compromised amount of debt in terms of a deed of company arrangement, subject to terms of the deed of company, and an opportunity to get control of your business back. And Scott, correct me if I'm wrong, although you're acting in the best interest of the company and its stakeholders, the best result for everyone would be to, particularly for the directors, is if when your company gets put into VA, that creditors not only get some of their money back, but the company then can continue trading on, continue to employ its former employees before the VA, and those directors who are emotionally attached have built up a business over that time, get another opportunity of running their business again. I would say that I'd probably be the best result in the DOCA scenario, right?
Yeah.
Can I just ask a quick question? Scott, what's your experience with the ATO accepting DOCAs? Are they usually quite accommodating? And also, just a quick question on that, you mentioned the directors' personal guarantees for DOCA payments. So is there any sort of assessment as to the strength of that guarantee, as in, what personal assets do directors hold before, is that part of the contemplation of accepting a DOCA?
Yep. So to go to the tax office position is that they take a public interest approach. And I've had instances where they voted against a deed of company arrangement, and they have also, in that circumstance, been the largest creditor by a very significant sum. But all creditors get a vote, and the way that the vote works is the casting vote system. So you've got to have the majority in value and number voting in favour for a DOCA proposal to pass. If the ATO is the largest creditor, it only has one hand in the air, but it may hold the largest value. But it may be the case that, say, a restaurant business may have 20 employees that may be owed entitlements and superannuation. That might be significantly less the tax office. So they'll have 20 hands in the air, but they'll have less value. So then it falls down to the administrator to use the casting vote. So in circumstances where the ultimate outcome for the DOCA is better than what the case would be in a liquidation scenario, is that, and at risk of oversimplifying it, you can almost rest assured that the administrator is going to use the casting vote in favour of the DOCA as opposed to liquidation. Now, in terms of the guarantees that directors are asked to provide for the future payments, now they're not obliged to provide a guarantee. We do an assessment as to their personal financial circumstances, and that's for two reasons. Firstly, to consider whether or not they've got the capacity to guarantee the future DOCA payments, but also because we've got the obligation to, when we're recommending a DOCA or liquidation, we've got to understand what their capacity might be to pay an insolvent trading claim if there is one available. And so we're asking those questions in relation to their personal financial position at that time anyway. And again, there's no obligation to provide those details, but from our responsibility perspective, it does make it a little bit easier if we can put our hand in our heart and say, well, we've got a stat deck from the director saying they've got A, B, C, D assets behind them. And this is the reason why we think the return under the deed is, the DOCA might be better than it would be in a liquidation scenario, or vice versa.
Yeah. Scott, we'll come back to liquidation, I think, in a minute, but I know we chatted previously about a pub that you were involved in with the safe harbour provisions. How did that work?
Yeah, certainly. So that's an ongoing conversation at the moment in the formality of that appointment. So it's a regional leasehold pub. It's been trading for any number of years. For many number of years, I should say. The directors have actually listed it for sale, and they have received a few offers of significant quantum. However, in the lead up to, or probably just after Christmas time, is that they've entered into more significant negotiations, but because of the seasonal nature of the trade, is that their income's declined. So they're having to top up working capital to meet the tax office obligations and occasionally put some money back towards the landlord. Now, what they're looking at doing is an all-encompassing plan to put their hand up for safe harbour, which will give them the time to be able to continue negotiations to reach a consideration which represents the value of the pub, without having the risk of an insolvent trading claim exposure if the proceeds from the sale of the pub aren't sufficient to discharge all the creditors that they may have otherwise incurred during this period of time. So it's them trying to seek some sort of personal protection. And there's also the aspect of it as well, that with the current circumstances is trying to have a broader plan which encompasses, well, the current situation as well.
Yeah.
Scott, sorry, Bruce, can I ask a question? Scott, in circumstances of SMEs or smaller businesses, the prevailing question has always been, do we qualify for safe harbour provisions? Is it a best practice for small businesses, or is it better to go down the VA route in those circumstances? There is a dichotomy stating that, you know, safe harbour provisions and the implementation of those kind of strategies are best rested with larger businesses.
I think it's a great question.
Yeah, but so what do you find in your area? Is it best to go down one route or the other?
Well, I think that in the SME space is I think voluntary administration is going to be the best fit, without generalising too much. And the reason for me saying that is that Safe Harbour is predominantly targeted towards the big end of town, so your large, say 100 million plus, where they'll have access to working capital to be able to continue trading throughout the process with a view to a genuine turnaround, whereas the voluntary administration regime has that moratorium, whereas the Safe Harbour regime doesn't. So with the voluntary administration regime and the moratorium, is that it gives the administrator the breathing space to be able to get in there, do their assessment, presumably receive a DOCA proposal, and then get out quite quickly as well, so the company continue to exist in the similar form, or at least as most similar form as it was prior to administration, whereas Safe Harbour doesn't give you that breathing space.
Yep. If anyone's got any questions, we've been answering the questions on the way through, but if anyone wants to use the raise the hand function and ask a question, please do so, and Jeanette will mic on for you. But if not, we might go to a liquidation type example. So where you've got a voluntary administration that leads into a liquidation, I know you've talked about a group of restaurants that you were involved in with that scenario. How did that work?
Yeah, certainly. So that was a typical voluntary administration at the start, and there was about a dozen restaurants, and we took steps upon appointment to essentially right-size the business. So the first thing that we did was shut down the stores which were loss-generating, and then put the profitable stores as part of the group to the market for sale. Now, during this period of time, anyone could have come up with a DOCA proposal as well. But over the course of time, we continued to trade the profitable stores. We received an offer for the purchase of the business as a going concern. And once the terms were executed and the sale settled, is then the creditors have the option to resolve to wind up the old, essentially the holding company, which was carrying the burden of the unsecured creditors' claims. And so when the liquidation starts, or I should say probably end, is that those debts that unsecured creditors have, which aren't personally guaranteed, essentially will cease to exist with the finality of that liquidation as well. So you've got the repercussions as you're dealing with the liquidated entity, so it basically ceases to exist. Where on the other hand, is that business in a more, if we can put this in this term, a more fitter, leaner version will continue to survive and still service the market as well. That right-sizing of the business approach is, I think it's one which is very, which would be very useful for people in the hospitality space which are operating multiple venues, because it could be the case that some are still doing quite well in terms of takeaways and delivery services, where there might be other businesses within those venues which are more foot traffic centric, which may not have been, say, trading all that well as well prior to the current situation. So you can shut down the quieter stores, and those claims, so the lease claims, the employee claims, and the unsecured credit claims will fall within the pot of claims under a DOCA or liquidation scenario, where the balance of the claims or the balance of the venues continue to exist.
Okay, we've only got 1 minute left, so we haven't got time to go through any of the other case studies. But Tech, have you got any other last minute questions or comments?
Well, just going back to the top of the presentation, knowing it's 1 minute left, if our viewers and listeners are thinking that there's no light at the end of the tunnel following these COVID-19 shutdowns, best get in front of your professionals and get some advice. It's not there's no obligation to follow that advice, but I think under the circumstances, you're best placed to get in front of your lawyer, get in front of insolvency practitioner, get in front of your accountant, work something out, And if there are protections available to you under the Corporations Act or under any of the mechanisms or courses of action that we've discussed today, sit down and go through it. It might be the fact that you walk away from that meeting saying none of it's for me, none of it's for my company. I'd rather just wait this out, but at least get through them.
Yeah, Paul, are you okay? Anything else to add to the discussion? All good? So
All good.
Scott, how about you? Anything else?
Look, I can't echo Tech's comments any more than what he said, because it's just knowing your options, getting some good advice, and just knowing how to protect yourself and move forward.
Great. Well, thanks, guys. Fantastic discussion. As I mentioned earlier, all of the people that are joining today, we will send out an email to everyone with some information from both Scott at Worrells and from Blue Rock around some of the options and some cash flows and some strategies and some stimulus package information as well. So thank you very much. Thanks for joining us, and stay safe. Thanks.
Thank you.
Thank you.